The third quarter was a bit of a break from what had been a raging bull market following the pandemic lows. Those lows were reached in March of 2020, and just about all asset classes have appreciated very significantly since those lows. But in the third quarter, we had a number of questions arise that led to volatility in the marketplace. The first was the Delta variant, but we also had a number of other issues surrounding the inflation and whether that inflation was transitory or persistent. That relates to unemployment, and that also relates to the future direction of Fed policy here in the United States. And what ultimately happened was the S&P 500, a good representation of the US markets, finished slightly positive, but just about every other asset class was down for the quarter. We've certainly seen a fairly strong rebound since the third quarter. And I will mention that rebound was moving along nicely until last Friday, at which time we discovered the new Omicron variant. And once again, the markets have been quite volatile, both down on Friday and up again today. So let's talk more specifically about these investment portfolios. We move on to the next slide. We first have our endowment portfolio. You can see for the quarter, the endowment underperformed its benchmark slightly, but was up 1.4%. And I will say the fact that the portfolio was up was pretty remarkable in itself. We often look at a peer group of endowment and foundations of similar size. And to give you a sense, that peer group's median return was down 0.3%. So a positive 1.4% return put us in the 12th percentile, 1 being best and 100 being worse. A lot of the drivers here, we've talked a bit about our private equity and private credit book, which we have been building up over the last several years. Private markets have continued to see massive appreciation. And we were certainly beneficiaries of that appreciation during the quarter. Our real assets portfolio was also a positive performer for the quarter. You can think about real assets as tangible assets that are designed to provide an inflation hedge. And as we saw pretty high inflation prints for the first time in a number of years, that segment of the portfolio did its job and appreciated. Equities were mixed. I will say, like the S&P 500 exposure was slightly up, but if you look outside the US, markets were down, and in the emerging markets alone, down 8% for the quarter. Now, we're fortunate that the two managers we utilize in the emerging markets portfolio did a lot better than the index. They were down 4% total, but still a pretty significant lag, given the fact largely that we had China come out and put new rules into the market that led to some fairly massive declines in asset valuations. Let's go to the next, but before we go, Jenny, let's flip back and let me just talk about the longer term returns here. I think it is worth mentioning that for all periods, year to date to 10 years, we are outperforming our policy index. That is a index of indexes that measures how well our portfolio would do if it were entirely invested passively, and some very, very good results over the long term. So I think that is definitely worth mentioning. On the next slide, we have our long-term portfolio, down 0.4% for the quarter and slightly trailing its policy index. So as I mentioned, it was very difficult to produce a positive rate of return for longer term assets during the third quarter. And many of the same themes for the endowment weighed on this portfolio. Real assets did a fairly good job of protecting value in an inflationary period, where areas like fixed income produced a slightly negative rate of return with interest rates as low as they are. I might just mention that this exhibit at the end of the quarter shows 13.6% in cash. Please note that was a transitory event. We had a large rebalancing that we did at the end of the month. This portfolio typically runs with very, very low to no cash, and it will continue to run with very little to no cash. This just happened to be some money moving at the end of the quarter. Longer term results, fairly good on the year to date, 1 year, 3 year basis, slightly behind the index, but also fairly good results for the 5, 7, and 10 year periods. Let's move on to the medium term portfolio. This portfolio is made up of about 65% fixed income. I mentioned fixed income markets were flat to down for the quarter. So it should be no surprise that this portfolio produced a slightly negative rate of return. Fixed income is a very, very difficult spot today to see any type of sizable return like we've seen over the last 30 to 40 years, simply because interest rates are very, very low and unlikely to fall dramatically from here. So that will present a bit of a headwind for this portfolio on a go-forward basis. That said, longer-term returns are quite good here, as we have been in a declining interest rate environment for a number of years, and this portfolio was able to take advantage of that. The next portfolio is our intermediate term portfolio. This is fairly new. We launched it at the beginning of 2021. And so you see it doesn't have a very long track record. It's invested 100% in fixed income. And so my previous comments are very applicable to this portfolio. Fixed income has been a very, very difficult place to make money. And then finally, we have our short-term portfolio on the next page, invested entirely in money market funds. Now, money market funds correlate to short-term interest rates. And with the pandemic volatility in the first quarter of 2020, the Federal Reserve took short-term interest rates to zero. And you can see the quarterly returns here went from positive to flat and remain flat. And we wouldn't expect this portfolio to generate any income in the near term as long as interest rates are stuck at zero. So let's move on now to our short-term portfolio. Our sustainable portfolios. First, our sustainable endowment portfolio. It's about 70% global stocks, 30% bonds. And we've had a very, very good run of performance here. This portfolio is almost 2 years old at this point, but results have been incredibly strong. In 2020, energy markets suffered. This portfolio does not invest in energy producing companies. So by not having those companies in the portfolio, it did quite well. Energy has been up and down throughout the course of 2021. But we have still been able to generate a positive rate of return. If you flip to the next page, our sustainable non-endowment is very much the same story. This portfolio is invested just like our sustainable endowment portfolio, same managers, same allocations, and therefore similar results. So with that, we're going to wrap up and conclude our third quarter 2021 update.